Hey everybody, Marty Missouri. Good afternoon, October 10th, 2018. Try to keep the video relatively quick, although I'm going to jump around a bit this afternoon. I'm kind of doing this on the fly. Obviously, I'm coming to you because the market took a big hit today. Dow was down over 800 points. NASDAQ was down 4%. S&P was down 3.3%, roughly the same as the Dow. So needless to say, not your typical day in the market, although we've had a few of those this year. The last one that big was in February. We had like days in January, and we came really, really close in March on this day right here. But this was the biggest one since February. The chart here kind of just shows you we had that big run up until January 26th, and we had our correction, 10 point something percent. Came up, resisted the 50-day moving average, and then came down, tested that low right at the 200-day moving average. And that was support. Came up, struggled with the 50-day some more, then ultimately that became support, which it tested right here for a day yesterday, and then kind of blew right through it. So the next test will be the 200-day moving average, which is about another, looks like 20 points down. Less than 1% for the S&P. So if we get follow through tomorrow morning, which we very well could because we ended on a down note today, we could very well test that 200-day moving average. So that's what technicians talk about and look at. Some people just trade or invest solely based on these charts. So the long-term, technically oriented investor looking at the 200-day moving average, which is arguably the most respected long-term trend indicator, would have a real caution signal when the price breaks below there, as it did right here, but really wouldn't begin to rotate away from their longer term positions until the 200-day actually rolls over. And as you can see, we're still looking at a pretty nice upward slope in the 200-day moving average. So technically speaking, there's been some real short-term damage, but there really hasn't been any long-term damage at all at this point, at least in the S&P 500. So what's going on? Well, the headlines everywhere are saying higher interest rates has got the market upset. And that was pretty much what was happening here. We had a really good wage number. People freaked out, said interest rates are going up. I wrote kind of a whole essay on market cycles and how the market will react to the threat of higher interest rates when it's been living off of very low interest rates for a very long time. But then ultimately, you have your correction, you have your consolidation, you begin to work out of it, and then the market realizes, and if I can talk about the market anthropomorphic terms, the market realizes that, wait a minute, higher interest rates in an expanding economy are just part and parcel to economic cycles. And there's a lot of history. I could show you lots of charts that show stocks going right up with interest rates for quite some time before everything begins to roll over. So if we've already had that period, as the headlines would suggest we're having it again, is that really the story? Should we really blame the Fed, as a lot of people are no doubt going to do going forward? I don't think so. I'm not saying that if the Fed wasn't hiking that the market wouldn't be declining like this. But I don't see how the Fed can't be hiking, quite frankly. And I know not everybody agrees with me. But we have about a 2.25% Fed funds rate, which is still remarkably low by historical standards. We have a Fed balance sheet that sits with $4.2 trillion of fixed income securities that it took off of bank balance sheets and replaced it with cash in their reserve accounts to help get through the greatest recession since the Great Depression back in 2008. The Fed really doesn't have much firepower, frankly, to do battle with the next recession when it ultimately gets here. If it gets here relatively soon, I have some concerns about the complexion of the next recession and how we're going to handle that in client portfolios. Right now, though, that's not our worry. Right now, conditions tell us to pretty much stay the course. At the margin, I've made it very clear that I'm not bullish on technology currently. Ironically, it's been tech the last week that's really been getting hit the most. Tech has had a very good year this year, but it's had a good year when it wasn't really the best setup going in by my assessment. It's had a good year because it's been, by and large, exempted from the tariff war, if you will. Other areas that actually look better to me industrials, materials, and financials. Not that financials are a big part of the tariff situation, but the tariff situation creates enough uncertainty up until here recently. I think that had kept kind of a lid on longer term rates. So here's the problem. We have a really good economy right now. Growth rates are fine. Employment is remarkably good. Wages are beginning to rise. The Purchasing Managers Indexes, the Institute for Supply Management surveys, all of them are very optimistic on the near term, but they are starting to grumble about the longer term. And with very few exceptions, their concerns are tariffs and what it's doing to supply chains and what it's ultimately doing to their business. Therein lies the problem. I don't think we would be seeing quite the stress in the market, although we've got midterms coming up and so forth. But ultimately, a huge headwind would be out of the way if we didn't have this headwind of a potential trade war. Now, I've maintained from the very beginning that ultimately the market will be the thing that gets the two sides together and they come to terms on the tariff stuff, which really isn't the issue. The issue, and I've been very candid on the blog, the issue is not the trade deficit as it has been reported to you. I do think there's a serious issue with intellectual property theft. And I am in the camp that says this is no way to deal with that. If I'm right about what I think will inspire better decisions there, then this sort of action that we've seen over the past week or so is actually pretty good action because it may ultimately lead to a getting rid of a headwind that stands in the way of an economy that I think should have a bit more to run. As I've expressed here over and over and over again of late, conditions don't tell us to get bearish, don't tell us to get overly defensive. Let's look back here at late 2015, early 2016. We had two back-to-back 10% corrections. This was a really rough time. At no time did our macro index, when we backtested, go into the red. It got lower, it got to 18. But from here, we started a very nice working out of what turned out to be a 2-year kind of consolidation. And right now, with all this green in terms of the macro index, this is what we have to view this as volatility to ignore for the most part, and just another consolidation. If we had this reading here, or if we had this reading here, we'd be doing dramatically different things in terms of getting defensive within portfolios. Here we had a 20% correction in the market, but we still had good general conditions. So if we got panicky and sold here, we would have got whipsawed, and in no time, we would have absolutely regretted that. Now, there's no guarantee here, folks, that our index is going to be as telling going forward as it has been in the past. But it is something that we do respect and we pay very close attention to. At the end of the day, we kind of view the world this way. When conditions are fundamentally good, and the technicals, these are weekly moving averages with the fast on top of the slow, are sloping in the right direction, we stay growthy until the evidence changes and we just live through volatility. Here, on the other hand, we have negative fundamentals, and a rolling over of the technicals. Here, you maintain a defensive asset allocation until the weight of the evidence changes, and we want to preserve principle when the setup looks like this. Folks, this is as of Monday. This is dipping down here a little bit. It's going to look more like some of these periods in here, but we don't have anything here yet that says we should be panicking despite the depth of the sell-off in a day like today. Okay, so I want to spend a minute on exchange-traded fund money flow. What I'm going to paint for you here is a picture of what we call rotation as opposed to wholesale panicky selling of stocks. Here I'm highlighting the funds with the greatest degree of outflow over the past week, and it's been the past week that's been so rough. Here's actually the one-day outflow. Notice that Invesco QQQ tracks the NASDAQ 100 index. Has a lot of technology exposure in it. $2.7 billion have flown out of that fund over the past week. On a year-to-date basis, though, it still has $1.9 billion of net inflows. So again, an ETF that tracks the NASDAQ 100, which is loaded with technology shares, with the FANG stocks, etc., was sitting on about $4.2 $4.6 billion of inflow. And that's been taken out to the woodshed here just over the last week. Notice the technology select sector ETF, one that we use, $738 million of outflow, although one day we actually got some inflow. And the fact that it's down $400 million on the year tells you that up until this week, it had net positive inflows. Now let's go to the other side of the equation and look at the ones that are getting the most. Ironically, this is our core ETF, but financials are something that we've had a lot of conviction in all year. Notice that over the last week, it's had over $1 billion of net inflow. And on a daily basis, 164 million. So notice, while the market's been going down, and while even financials sold off today, they held up for most of the morning and then finally capitulated with everything else. But on a net basis, people are, and I think this is smart money, is going in and buying financials because they're seeing that there's some rotation going on. And I think that makes a lot of sense. So again, we have a situation where money is flowing out of technology stocks and into things like financial stocks. This is not everybody running for the fences. And I know you can get caught up in the price data. And I understand that, meaning it feels like everybody's running for the fences. But this tells us there's actually money flowing in. Now, it is buying at lower prices, and that's what you're seeing. But what it says is that on a net basis, there has been cash flow coming into those funds. So these are opportunistic buyers. I don't know if their timing is going to be good or not. As I suggested, there are imbalances in the market that I think need to be remedied, and this is a very healthy correction. More importantly, I hope that it will inspire some coming together on this whole trade stuff, because I think if we can get through that, I think we get through the worst of what's going on and what's impacting the market right now. And then lastly, of course, we have the midterm elections. History suggests you get some volatility leading up to midterms. Typically, you get a very good market post-midterm elections. Again, we have this other headwind right here that we unfortunately have to deal with. And then lastly, back to our chart. Remember last week, I said, again, mid-single digit, low double-digit decline. Low double-digit would be the definition of a correction because that would be more than 10%. So when we look at a one-week chart, we can see right here is where things began to fall apart. So over the last week, we're at that mid-single digit point for the S&P 500, down 4.75%. Now again, I'm not predicting that we jump up from there or that we go down, and it doesn't get worse before it gets better. But at the end of the day, with a decent fundamental backdrop, this right now, for the most part, aside from tweaking that we will do within the sectors, this looks like volatility to ignore. If and when conditions roll over and probabilities begin pointing to a recession and a protracted bear market, then of course we'll be having a different discussion and we'll be doing vastly different things within portfolios. Right now, this looks like volatility within the context of an ongoing bull market. Thank you as always, folks, for watching and listening. And of course, there'll be much more on the blog to come. Take care. Bye-bye.